Hi, I'm Kep Kepner, CPA here in Dallas. Well, the good news is that the IRS has 22,000 fewer auditors. So that means your odds of getting audited are less this year than they have been in the last 5 years. The statistics say that 0.84% of individuals get audited. So that means odds are you're not going to be audited. As your CPA, I'm going to advise you about that, but I'm also going to advise you to record your tax information properly. I'm not going to lie for you. No CPA that I know would do that. Our job is not to audit you. That's for the IRS to do. Our job is to protect you. Our job is to make sure that your tax return doesn't have any large red flags that you're waving in front of the IRS. Because if it does, and you're one of those 0.84% taxpayers who's audited, then you might end up owing additional tax and penalties and interest, and the IRS may audit you for not just last year, but for 3 years, and they might have you then on their radar so that 3 years from now they might do it again because they know they caught you. So you should look to your CPA for advice about what's on your tax return. You gather the information, you submit it, we prepare the tax return, we look at your deductions, make sure that you're getting all of them, and we're making sure that you are not putting stuff on your tax return that's going to cause you to be audited. The IRS statistics show that if there's a large partnership with over 100 partners, that'd be like a large real estate or oil and gas partnership. They've streamlined the way that they're processing, and they can audit at the partnership level, assess a tax, which then gets incorporated into the partners' K1s at the partnership level. If you have less than 100 partners, the partnership can opt out of that. So let's say the IRS audits and finds understated income of $100,000 for a partnership that has 99 partners. So approximately $1,000 per partner. And so the partnership can either pay a tax and keep you from having to pay extra taxes and amend your return, or they can opt out of it, sending you an amended K1 and requiring you to amend your tax return because the partnership didn't do something properly. So with everything with the IRS, there's a give and there's a takeaway. The give is we've got rules to make it easier to audit these large partnerships and to let them pass that audit correction on to you in the year that it's found. But the takeaway is, oops, well, the reality is we really can let the partnership escape on it, and you then have to amend your tax return, which causes you additional time, money, and agony. So with the IRS, you get and you give, and hopefully it'll balance out in your favor, and it can if you have really good tax advice. If you need help in that area, give us a call. Thanks.